How's everyone doing? Fantastic. This is my favorite nights of the month, is when we have the opportunity to have the Live It speaker series. And we just finished an amazing podcast, which I hope you all check out. I think we'll probably release it maybe within the next week. So, and grateful to Eric Barlow. I don't know how many of you, can we give Eric Barlow a big round of applause? Eric, as you know, is a dear friend of mine, and we've been friends for a long time, and he is the one who introduced me to a couple of his business partners that have been so good at doing some of our Live It speaker series for us this semester, and it's just been a fantastic thing. And Eric's put together investment opportunities, you know, for people who are working here too, and I'm pretty excited about that. I don't care whether you do them, and I think I've said this before, I don't have any stake in any way whatsoever in it. I'm just trying to help give you opportunities you could not otherwise have. It'd be very difficult for college students to be able to invest with a company like Andina. But I'm very excited to introduce our guests for today. Are we mic'd up and ready? So these guys are like twin brothers. But I'm very excited that we have with us the directors of a company called Mercatus Partners. And Mercatus is I'm going to let them explain what they do. But as you know, Chris Russell is the managing director of Mercatus, and I'm going to let Zane introduce him. Zane Beatles, who I'll introduce here coming up on the stage, is a former All-American University of Utah football player and a 9-year NFL veteran. And he is an executive vice president, or the executive vice president of Mercatus Partners. So, without any further ado, Zane Beatles.
All right, guys, how are we doing tonight? We were sitting over there having dinner, and I hear all this stuff that's going on. You guys are getting me juiced up in here. I'm happy to be here. Happy to talk to you guys. Thanks for having me today, Jason. Thanks for having us. Really appreciate it. Looking forward to talking to you guys, sharing some life stories, and then getting into a little bit about real estate. Oh yeah, the clicker. There we go. Did that work?
It's going to work in a second, Zane.
All right. Oh. Am I pushing the right button? It's just the big one in the middle, right?
Yep.
Oh, I got to go back. What's going on here? There. We're good? All right. So, this is me in another life. That was a few pounds ago, and before a much-needed haircut. And while my work uniform here looks different than your guys' work uniforms, I'm going to tell you why we're not that much different from each other. I and other professional athletes are fortunate, like many of you, to make a lot of money early in our working careers and working lives. And I, like many young people who work hard and experience financial success at a young age, think, wow, this is easy. I can't wait to invest this money and grow it and compound it. Private jet life, here I come. Like, you know, it's exciting, right? I first, in my NFL career, hired a wealth manager that was from a national bank and started investing in stocks and bonds, you know, simple stuff, which is definitely a good place to start, right? Then I learned a little bit about something called venture capital. I think you guys had Pier 88 in here a few weeks ago talking about some VC stuff. And I learned the astronomical returns that you can make in venture capital investments. And I got a little excited. I got a little too excited, honestly. Through a family relationship, I was presented with an opportunity to invest in a startup company. This company leveraged technology to deliver various types of mental coaching and education in the sports performance world. I really liked the guys running the business. I understood the vision of the company, and I decided to jump in and partner with them. And I invested a lot of money, and I mean a lot of money into the company. And they put in the labor, they ran the day-to-day of the business. I sat on the board of the company, I was part of monthly meetings, and we were always right on the verge of making something really special happen, or at least we thought we were. If you can scroll down on my notes, yeah, thanks. So, you know, like I said, we were always on the verge, or at least thought we were. And so I kept putting more money into the company to get us over that hump. And the vision of that pie in the sky investment return really got me caught up. Unfortunately, the company failed, and I had to move on, and so did others, and all that money lost. That experience taught me that I needed to surround myself with mentors and advisors who I could trust and guide me and educate me on what was best for my personal journey and my personal situation, and the pitfalls to look out for. Eric Barlow, who Jason mentioned, was one of those mentors and advisors for me, and his company, Andina Advisors. I became a client of Andina. I've known Eric for a long time, and he helped me get exposed and learn about the private investment world and get into some good venture capital, private equity, and private real estate deals. I'd also like to share some more about what I saw around me during my time in the NFL and some mistakes that some young guys were making. The first story I'm going to share with you was a guy who was drafted in the late 2000s. This was before rookies kind of got a cap put on their dollars that they were able to earn on their first contracts. So this guy made a lot of money. And he was regularly going to Vegas with his entourage. If none of you have seen the show Entourage, I highly recommend it. It's a great watch. But he would regularly go to Vegas with his entourage with a duffel bag full of stacks of money. And he would take out $10,000, he'd throw it on the roulette table and lose it in one roll. And then he'd put his hand out and have somebody in his entourage put another stack of $10,000 in his hand, put it on the table, lose it again. Sounds like a movie. This was real life, something that I saw happening with this guy. Another couple stories. I got drafted to Denver, and my rookie year there was two guys. One of them was a 7th round draft pick, and one was a college free agent. Neither of them made a ton of money on their first contract. They both made the team through training camp, and after week 1, when we got our first paycheck, they both went out and bought BMW 7 Series sedans. The BMW 7 Series is the most expensive stock sedan that you can buy in a BMW. Probably not the best use of the first amount of money that they made in their NFL careers. Later on in my career, again a rookie, again undrafted free agent, hadn't made a lot of money, was living paycheck to paycheck during his rookie year, literally paycheck to paycheck. And he was going out buying all kinds of luxury clothes and jewelry and bags and showing up to the game with all his new stuff every week. That next off season, he was going around asking teammates for loans because he didn't realize that we only got paid during the 17 weeks of the season. He didn't realize he needed a budget to bridge the gap until we got to the next season when we would be able to get paid again. And then the last story, again, later in my career, was a young guy, a rookie, that was a first-round pick. So he actually got a good amount of money on his first contract, got a good signing bonus. And we were on the bus heading to a road trip one day. And I was sitting around with some other older guys, and he walked in wearing a watch very similar to the one that you see up here. And I don't know for sure. I don't own a watch like this, but this thing's got to be over a $100,000 watch. And trying to mentor this guy and give him some advice, we said, you know, maybe you should try to establish yourself, make sure you're going to make a long career out of this before you go around throwing money like this. And he looked us square in the face and he said, what are you guys talking about? This is an investment. Jewelry doesn't go down in value. I said, all right, we got some work to do here. All right? So I tell you some of these stories, and I'm not saying that you shouldn't enjoy the fruits of your labor. You work hard, you should be able to enjoy that. But you should do it in a sustainable way, because you, like me and others, have an opportunity to build wealth that will last a lifetime and build and leave a legacy. A lot of people who have success early in their careers make the mistake of assuming that their subsequent ventures will lead to similarly quick success. And that tends not to be the case. My story about the venture capital, you know, I had this vision of that private jet set life because I got caught up in that. And it usually takes just as much effort or more the second time around. You got to switch your mindset to play the long game after a great jump start, and that's difficult to do. There's no doubt about it. Being successful in investing means putting in at least as much time as you do in your day job, or having an advisor to manage it for you. Oh, there we go. There we go. All right. So here I am again, now after I retired from the NFL, with a slightly better haircut, with my wife and my newborn twins. And it was time for the next phase of life. I was so excited. I'd invested through funds, which some of you may be familiar with, but it's where investment managers pool a bunch of money together to go out and invest in companies, real estate, whatever it may be. And I had done that in commercial real estate throughout my NFL career, but I felt like I could strike out and do it on my own. So I bought this duplex you see here up in Holiday. I converted a garage into a bedroom. I added 2 bathrooms to the building. I completely separated the 2 units, and I owned it and operated it for about 2.5 years. Put some renters in there, had tenants. They were paying my rent for me. Things were great, and I sold it for a nice profit. Really, that was probably more of a factor of the market. I sold it in 2022. So, you know, not too long ago, and values had risen a ton throughout COVID, as some of you might be aware. I'd like to think I made some good, smart, prudent decisions, but I can't take all the credit for that. Ultimately, what I learned is that it required more time and headache than what I wanted. Renters were calling at all hours with issues with the place itself or even with each other. I wasn't interested in being their therapist. You know, I had young kids, a wife, I had hobbies, I was going back to school, and I wanted time for my passions. And I realized that what I have access to at Mercatus Partners, and we'll get into here in a little bit, and through the fund model was a better fit for my lifestyle and investing goals. So I'd like to get into a little bit of high level of just what is commercial real estate, educate you guys a little bit on that. All right, so you see up here on the screen different asset types. You got office buildings, industrial buildings, multifamily housing, retail, self-storage, data center, hotel, raw land. That's kind of the much of the commercial real estate landscape. Now, all of these product types come with different risk-return profiles and have unique opportunities and challenges. I'm going to highlight a few of those here for you. The first being office. Office is historically one of the highest return asset classes in real estate. However, occupancy, the number of tenants that you have in the building, can fall to very low levels. And even if you bring your rents down, that's not always going to entice businesses to come in and take your office space. It's also very capital intensive. The owner has to come out of pocket to fund tenant improvements, pay leasing commissions to brokers, and there's constant turnover in office buildings. The next asset class is hotel or hospitality. These can generate very high cash-on-cash returns, which is correlates to the income that you receive based on the amount of cash that you put into the project. You scroll up on my notes there. However, a hotel often carries more risk than any other product types because of a seasonal and cyclical nature. Think of when people are going on trips, or if the economy enters a recession, people aren't traveling and going on trips. Business travel, COVID hits, and nobody's moving anywhere, right? And room rates and occupancy can fall through the floor through that economic turmoil. Next product type is retail. These tend to have longer leases, providing stable source of cash flow without questions of future income, which is great. However, they tend to not appreciate in value as much as other product types. So really kind of a steady as you go type product. You can keep scrolling up there, please. Two more to highlight here for you. Industrial, which we do a little bit at Mercatus Partners, and it's an asset class that we like. You think manufacturing facilities, distribution centers, and warehouses. They've been proven to be strong investments throughout time, and they're often less affected by economic cycles, which is great. However, changes in trade or transportation patterns can reduce demand and negatively affect the value of your asset. The last one is multifamily housing, and that's mainly what we focus on at Mercatus Partners. This includes apartments, townhomes, condos, and this asset type is much more resilient through economic cycles and downturns due to stable housing demand. Everybody's heard the term, everybody needs a place to live, right? It's also more inflation resistant. We've been in a very high inflationary environment the last few years. Multifamily has shorter lease terms, so you're able to bring your rents up to market rates much more frequently than other product types, and also bring your value up with it. Challenges with multifamily can come from oversupply of new construction or population shifts, people moving from California to Salt Lake City, and which reduces the demand for those rental properties and negatively affects your value and cash flow. A little bit about commercial real estate valuation here for you. All right, so that get into a little bit of math. Don't worry, we won't get too crazy here. But property value, very simple equation. It's your net operating income, or your NOI, divided by your cap rate, which is a percentage, okay? Net operating income is made up of your rental income, ancillary income, your total income, minus your direct operating expenses, excluding any debt or financing costs. Now the cap rate or capitalization rate is the most popular measure that is used in commercial real estate to assess return potential, and simply represents the yield or the return of a property over a 1-year period if the property was purchased with all cash. That's what a cap rate is, all right? Now, cap rates are driven by perceived risk. There is no, other than this formula here, there's no formula to calculate a cap rate. And it's really driven by investor sentiment, both in a location and a product type. Riskier assets tend to have higher cap rates, so you have a higher return, but you would expect there to be a higher risk that comes along with that. That's not always true, but that's a generalization. Certain real estate investors may prioritize different things. Some want preservation of capital, or don't lose my money, right? So a lower cap rate, lower risk makes a lot more sense for them. Others are more yield driven. They're willing to take more risk for a higher return and compound their money over time. This risk tolerance really varies by investor. So it's something that you have to determine yourself of what you're willing to do. I want to draw a correlation that some of you might be more familiar with, anybody that invests in stocks. Stocks are often valued through a PE ratio. So if you equate net operating income to net income from a company, and you equate property value to market capitalization, an inverse relationship between these two becomes clear. All right? Basically, they're on opposite sides of the fraction there, right? With that inverse relationship, a lower cap rate implies a higher value, while a lower PE ratio implies a lower value of a company. Now, before I turn the time over, I want to highlight a few benefits of investing in real estate and kind of set the stage for bringing Chris up here to talk to you a little bit deeper about some stuff. So top 6 benefits of real estate here. Cash flow and income generation, all right? This can be passive or active depending on how you choose to invest. Through a fund, very passive. Owning a duplex in Holiday, very active, all right? Basically, if your revenue is higher than your expenses, you get cash flow. It's awesome. All right, next thing, appreciation. Shelter is a basic need for all of us. People need a place to live, work, and play, which over time drives values up. Also, higher growth markets. Salt Lake City's been one of those markets for a few years now. Has more potential for appreciation of value in a project. One thing to make sure everybody understands is that appreciation can fluctuate as you hold a property, and you only realize the increase in value when you sell a property. All right, now some of you may be thinking that about dividend-paying stocks, right? Dividend-paying stocks pay you dividends, which is like income, and then they can increase in value, and when you sell them, you receive a capital gain, appreciation in the value of that. So why not just do that instead of investing in real estate? Well, you can see there's some other benefits here that we haven't covered yet. The first of those being tax advantages. Jason and I talked about this on the podcast that we just recorded, and it's a huge value in real estate. So like most businesses, you can deduct your direct expenses, things like your interest payments, insurance, utilities, maintenance and repairs, property management fees, etc. Scroll up there for me. Thank you. One of the most powerful things about real estate is the ability to depreciate your asset. So you come up with your net income after deducting all those expenses, and then you get to depreciate an asset over time. The IRS allows you to do this. So your net income that you have there further gets offset by this depreciation, and you pay even less taxes. One of the most unique things and most powerful things about real estate is that most assets that depreciate lose value or depreciate in value over time. Real estate has depreciation benefits, but appreciates or increases in value over time. Extremely powerful tool. Another aspect of tax advantages that we won't get into much, if you guys want to come up after and ask about these, there's 1031 exchanges and opportunity zone investing, both great powerful tax tools as well, but that's one of the great things about our real estate is the tax advantages. The next thing is leveraging your funds. Real estate is one of the assets that you're able to use debt to acquire. So you can use less out-of-pocket cash to buy a value or to buy an asset than what it's worth. And then you can spread your cash around to more assets, which is extremely powerful. Real estate's a hedge against inflation. I mentioned it in the multifamily. Value, as leases turn over, or as new renters come in, you can increase the rents over time. And as we saw in the equation of value, that increases the value of your real estate over time as well. So great inflation hedge. Equity is one of the benefits, okay? So as your property is appreciating in value and you're paying off your debt, the difference between the two is your equity in the property. And this directly goes to your net worth and increases your net worth over time. One of the great things that you can do with this equity is refinance. So if you put a new loan on a property and you refinance, you can take out some of the cash that you put into the property that's tax-free, and then you can use that cash to go around and buy more properties, invest in more things, go buy something nice for yourself, whatever it may be. So those are the 6 main benefits of real estate. There's 3 more that I felt like were worth mentioning here. Real estate is a physical asset. This is one of my most favorite things about real estate. We refer to it as sticks and bricks. But it has underlying value in the materials and the labor that is put together to put those materials together. Something that paper assets like stocks or bonds or investments in companies don't have. So it's, in theory, a little bit safer because there is that underlying value. It provides diversification. Real estate is not correlated to the stock market. So when the stock market's going down, your investment in real estate could continue to go up, which is great for an overall investment portfolio. And then one of the things that I enjoy most about real estate is it's something that matters. It benefits the community by providing housing or places to work and play. And it's something that I feel really good about when I'm putting my dollars into real estate, that I know that it's impacting other people. I told Jason earlier that after my football career, I developed a new purpose for my life. And part of my purpose is helping others to live happy and fulfilled lives. And this piece of real estate directly impacts that and contributes to that in my life, which I truly enjoy. All right, now I talked a little bit earlier about surrounding yourself with really smart people and really good mentors. So I'm going to bring up somebody that I've learned a ton from in the real estate space and that I have a ton of respect for. He's worked in the real estate space for his entire career, has touched all the 3 major universities here at the University of Utah, started at UVU, spent I think a semester at BYU, and then ended up as a Ute, so he's a good one, no offense to anyone else. But has worked for some top-notch companies, has great relationships across the country in the real estate space, and one of the smartest people I know. So Chris Russell, Managing Director of Mercatus Partners.
All right, how's everybody doing? Okay, thanks, Zane. So I appreciate you guys having us out here this evening. It's always exciting to come and talk to people about Mercatus Partners. Before I get into the company, I'll share a little bit about myself. I did not play in the NFL. I did one time coach my son's flag football team, but fortunately I do have real estate to fall back on. So I founded Mercatus Partners with a couple of partners, Eric Barlow sitting over there next to Jason, and Brett Belliston. We did that in 2019. About a year later, Zane came on, and we've been growing gangbusters since then. So I've always loved real estate. It took me, I was one of those 6 years in college types of guys, but it took me about 5 of them to figure out what I wanted to do with my life. And I looked at private equity. I just couldn't get excited about these companies that sometimes they had products that were tangible, you could hold, pick up and feel. But real estate, since I was a little kid, I was the one watching those infomercials, Friday night, how to make $1 million buying and selling real estate. But I couldn't figure out that's what I actually wanted to do with my career until a lot later on. Worked for a bunch of companies in the space. The last one before founding Mercatus was an insurance company called Pacific Life, Fortune 500 company based in Newport Beach. We invested on the general account. There was 4 guys on our transaction team, actually 3 guys and a gal, and we were responsible for investing about $400 million a year for the insurance company. So great experience. I learned a ton. Before that, I was with a boutique private equity real estate shop in San Diego. I worked with, we had to source transactions, multifamily apartment investments, and then go raise money for those deals. And typically the partners that we would partner with on those transactions were big time financial institutions, groups like PIMCO, BlackRock, GE Capital. So we go find a deal, we'd underwrite it, and then we bring in some of those groups to come in and partner with us and then buy and manage the transaction. Before that, I had worked with a group, a PE group, when I was in my master's program. But really where it all started was back in 2009. I spent my summer in Washington, D.C., working, it was a sales job, working for a little company. I don't know if you guys have heard of it. It's called Moxie Pest Control. Had an awesome summer. We crushed it. It was 2009. The entire world was in a recession. DC was doing just fine. Government spending, I don't know, it's a whole deal. But I think I had 1 cancellation the whole summer. Fantastic experience. And my hat's off to all of you guys and gals who have made the decision and who have made careers out of doing summer sales. And it's a grind. It's a ton of work, but you're choosing to do something productive and that's benefiting you for the long term. You know, you could, a lot of my friends were staying home and, staying on campus over the summer, sleeping till noon, taking 1 or 2 classes, hanging out with girls at the pool. But, the skills, the experience that you're getting and the skills that you're getting, being out, meeting with clients, honing your sales skills, those skills are going to be with you, and that experience is going to continue to benefit you for the rest of your life. You're going to, some of you may spend your entire careers working in pest control. A lot of you won't. But developing skills as a salesperson, I mean, there's so much value in that. My uncle is a tech executive, and he was president of a company based here in Utah. So he's president of a technology company, and his lead salesperson made more money than he did. So you guys are on the right track. Yeah, a round of applause for that. So keep it up. Work hard. Get as much out of this summer as you can, because it's going to benefit you the rest of your life. So enough about me. I'm going to get a little bit of the company and talk about what it is that we do. So Mercatus Partners, we were established. Really, Eric approached me in 2018. We were really set up to do one thing: to serve the investment needs of high net worth individuals and families, help them achieve their financial goals. So, our job is to work with those clients, provide a resource for making great real estate investments. And Zane went over the benefits. It's a fantastic asset class. You got depreciation. You've got cash out refinances. A lot of things that are, pretty unique to real estate that make it just a great place to put your money. So one of the first things we do when we're meeting with a new client is we try to understand what their unique goals are. So, but it's personal goals and financial goals, because, it really, if you want to have satisfaction in this life, you got to be going to work every day, not just for the paycheck. You got to have something more that's motivating you. Like Zane talked about, you got to have a purpose. And so, we're trying to understand what the goals are and what the purpose is for our investors. And at the same time, that's something we think about for ourselves all the time, every day. Actually, at this point, I want to get a raise of hands. So raise your hand if you want to be rich. Okay. All right. So the honest ones, just raise their hands. Thank you. All right. Now, can I get some volunteers? Why do you want to be rich? Anybody? In the back.
So I've always been poor. And I don't know, I remember both when I was in the Army. Call me Dad, poor dad. Oh, sorry. So I've always been poor. I've got 9 siblings. My dad's the only income in our family. And I didn't realize how much he struggled till I was like 18, 17, maybe 16. I started noticing that he had a bad knee, and he made enough money he could fix his knee or he could put food on the table. And that sucks. He eventually got fixed, but I personally don't want to be in that situation. Like, I love my dad with all my heart, but I want to be able to basically just reach any goal I want. I want to be able to have extra cash all the time, and I want to be able to help people.
Yeah, that's awesome. Hey, you want financial security?
Huh?
Yeah, fantastic. Thank you for sharing. Anybody else? Okay, so when I was going through school, I mean, I had aspirations to be a professional athlete too. I wasn't strong enough or manly enough to play football, so I played baseball. Unfortunately, I was plagued with injuries my entire career from the time I was 14 years old. So I came to Utah. I thought I was going to play baseball at BYU. I ended up coming up to UVU to play. Freshman year, I got injured, so I pretty much threw in the towel. But growing up, you know, I'm the only kid in my house that graduated high school and went to college. But I had this vision for my life, and it included, yeah, I was going to be a professional athlete and all the stuff that comes along with that. When that didn't happen, I said, you know what, I'm not going to, I wish I could have played pro baseball, but I still want to have that life. Like, I want to have that kind of freedom and flexibility. And so I was like, okay, what can I study? What can I do to be successful financially? You know, ended up studying finance and econ and choosing to get into the private investment space. You know, again, I talked to multiple people. One of those people I talked to was my father-in-law, who's a real estate developer. And he told me, you know, you are not going to be satisfied in life if the only reason why you are out, you know, working your butt off is to make a bunch of money. Like, you got to have a higher purpose than that. So I started thinking about that, and now it's, you know, something I'm thinking about every day. And you know, at this point, I really have that. I've got my kids and my family, and that's my number one motivator. I want to give my kids, really, I want to give my kids the life that I had growing up. I grew up, we lived on a great piece of property. My grandparents had a huge piece of property close by, and we were outside all the time. And I know nowadays it's kind of tough to have that kind of lifestyle, you know, living in the suburbs. And so it's like, that was it. I wanted to give my kids a place to grow up where they could live the kind of childhood that I had. And really, it's been very fulfilling to be able to achieve that in some measure. But you know, I hope that none of you guys at this point want to make money just to go out and buy the Bentley or the BMW 7 Series or the Cartier watch, because it's, at the end of the day, you're always gonna want more. You know, we spend. And actually, I got a story that I wanted to tell about that before I move on to the next thing. So, and it's about, you know, being satisfied in where you're at in life. I knew this guy a while back, older guy, and him and his wife had lived in an area for a while, away from home, away from their family, and they were finally going to get to go back and move back home. And I asked him, I said, are you excited to move home? Are you happy to be going home? And his response to me was really interesting and super impactful to me. He said, well, I'll tell you what, if you're happy where you are, you'll be happy where you're going. And I think about that saying all the time, because it's so true, not just physically where you're at, but like in every station of your life. If you're poor and you're miserable, money's probably not going to fix that. So, you know, having this motivation, having these things that are driving you beyond the financial side of things is going to be what brings you that satisfaction. Okay, so I'm going to tell you a little bit more about Mercatus and what we do and how we help our investors to achieve their goals. So we primarily invest in apartments. We do this across the U.S., but in some key markets that we really like a lot, that have kind of the growth story that we think is going to lead to great returns for our investments over the long term. So you know, we're investing in cities that have a great story as far as jobs go, places where young workers are going to be really interested and attracted to live, regardless of whether or not they have a job there. Places like Nashville, Tampa, Salt Lake City, and then also in states and in cities that are attractive to businesses to locate, because they don't have some of the restrictions and burdens of being located on the coast, trying to do business in New York or California. You know, we operate funds. You know, we're on our fourth fund now. We invest primarily for the family office, bringing in some Indian family offices, and bringing in some outside family offices into some of our transactions. Next slide. So we've done 27 deals, 21 of them that we have sponsored or co-sponsored ourselves, which means we just take a more active role. We're more actively involved, and also the economics are better for us as well. So we've invested on behalf of our clients close to $95 million. It's in total $2.7 billion in transactions, or 2.4 billion in transactions. On the co-sponsored side of things, 2.1, 7,000 units plus or minus, and we've earned a pretty good return so far for our investors. So want to get a little bit deeper into the power of owning real estate over the long term. Hopefully this is interesting to you guys. I'm going to tell you a little story about how it actually works, how it gets put into practice. So first off, I got another question. Do any of you guys have grandparents or great-grandparents who own commercial real estate in Sugar House? Do you know what buildings they own? What's the relative's last name?
So your question is if we had like family members that like own commercial real estate, right?
So commercial real estate in Sugar House, Utah.
Oh, in Sugar House, sorry.
Okay.
No.
But so your family owns real estate?
Yes.
Okay, where at?
In the Caribbean and in Miami.
Oh, very nice. What kind of real estate?
Hotellerie.
Say again?
Hotellerie.
Oh, very nice. Okay, very cool. Anything we'd recognize? Any brands?
So the name of the hotels is Hotel Bellini, 4-star hotel in the Dominican Republic, Hotel Montana, 5-star hotel in Haiti, and Hotel Cardoso in Miami.
Very nice. Very, very cool. It's a fun space to be in for sure. Hotels are kind of an asset class that once guys or gals have really made it in the space, you buy a hotel and it's like your trophy. So fantastic space, and it sounds like your family's been super successful doing it. I'm glad nobody's relatives own commercial real estate in Sugar House, because I'm going to tell a story about a client who does own, but none of you know who he is because you're not related to him, most likely, hopefully. So before I get into the story, I'll just to set the stage a little bit. The way that this investor benefited so significantly from his investments was, first of all, time, and then tailwinds that pushed, were helping out the real estate industry for decades, but then also the debt, his utilization of debt. So this is the typical structure of a real estate transaction. You've got, and right here in this bar chart, so institutional transaction is typically structured like this. You've got 65% debt, 35% equity. So your equity is, if you're the owner of the building, you're writing the check to buy the building, you're that 35%. And again, you own the building, you got the keys, the debt doesn't. So this was the first piece of real estate that this investor bought. And this was back in the 1970s, early 1970s. So this is Sugar House Furniture. It's no longer in this location. But what this investor did was he purchased real estate. He purchased well. He kind of got a little lucky in that he bought in a fantastic location that was going to get significantly better over time. But he took the money that he made and he reinvested it back into his business. And so over time, he grew his real estate portfolio to include several more adjacent buildings on the same block. So kind of started to own out a pretty significant chunk of real estate in what ended up becoming like a main location in Sugar House, which Sugar House, if you guys don't know, is an awesome location for real estate. Maybe one of the best. I mean, definitely one of the best in Utah. So now this investor, again, being really disciplined and prudent with his money, saved, paid down his loan, and then got to a point in the 1980s where he was able to buy this building. He bought it with a partner, but he's got a majority stake in this building, also in Sugar House, right up the street from his original. And so he did not sell the retail buildings, but was able to use the refinance proceeds, which are not taxable. So you get to take those out tax-free and then reinvest in something else. So this office building performed really well for him, so well that 15 or so years later, he was able to refinance that building and use the proceeds to build this one, which is right next door. You can see the glass on the other side. So he now owns two very high quality office assets in a great location in one of the best submarkets in Utah. Again, being very disciplined with managing his real estate business. He kept his leverage low as often as he could, paid down his debt, and then the value of his buildings went up. And several years later, in about 2010, he started construction on this building. Anybody recognize this building? So we got one here. So this is the View in Sugar House. At one point, this was the highest price per square foot rents in the entire state of Utah. So this is 211 units on the main corner within Sugar House. This building, so I met the owner of all this stuff when I was in my grad program, and when I was working at Pacific Life, he came to Pacific Life to try to refinance this building to do his next project. But just fantastic deal, and just a really, really good job of being a prudent real estate investor, and you can see how that ended up working out for him in time. So again, just to reiterate, he started with some small retail buildings. His first building, he paid around $100,000 for it. And then over time, if he still owned this center might be worth maybe $10 million, probably closer to $5 million. But because of how he invested, the center's gone now. The apartments are on this site. But he's gone from what would have been a $10 million portfolio to now this portfolio. I can get it to switch. This portfolio is worth at least $150 million. So again, it's hard work. It's a lot of work. You can invest like he invested. You can invest like our investors do, which is much more passive, where we do all the work for them. I think this project, this series of projects, illustrates the power of investing in real estate. Okay, so that's that story. I hope that was informative. I'm gonna ask a question. What's the number one rule of investing in real estate? I actually don't like this saying. I don't like this saying because it doesn't really tell you anything, right? What does this mean? So what's a good location? I like this. I made this up just the other day while we were putting the presentation together. I got a new one. This is what you should focus on when you're investing in real estate. Jobs, retail, and wealth. It's the same thing, location, 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 but just saying it in a more kind of precise way. So if I'm investing, let's say, in an office building, I want to have an office building where there's close to other office buildings so that it's an easy move for this company to move across the street because their employees are already come into this downtown area for work. If I'm just thinking, oh, it's a good location for real estate, I'll invest in real estate in that location. It's not always true. It doesn't work across product types. Like Park City is a fantastic location, right? For residential, for sure. Maybe retail. I wouldn't build an office building in Park City. There's very few people that are commuting to Park City for work. There's very few companies that are locating their facilities in Park City. So it's not just as simple as trying to figure out, this is the location, good location versus not. Retail is a little bit more nuanced as well. So with retail, how many of you guys are familiar with the Riverwood Shopping Mall? So you guys I'm sure you guys have been to dinner there. Riverwoods has a problem that I don't know if the developers had really thought about when they built it. So wealth is a huge thing for retail. You want to be surrounded by wealthy clientele because you want the shops that are located in your shopping center to have just a constant stream of people coming in and spending money. Problem with Riverwoods is you want to have, when you do retail, you want to have like be drawing from a circular radius area, and you're in the middle, and you can draw from all around in the neighborhoods all around there to maximize the amount of foot traffic you're going to get in your space. Riverwoods is located up against the mountains, so they only have a half circle. So they have not been able to pull clientele the same way that they would have if they were maybe up in Draper in the center where they could pull from 4 different directions. So they've always struggled. They may be doing better now, but they've always struggled compared to other like high-end shopping centers. And then with apartments, which we do, it's all three of these. You want to be close to job centers. You want to be close to retail, especially if you're trying to appeal to a younger demographic. Young professionals want to be able to, they want to be able to live close to work. Everybody wants to be able to live close to work, but they also want to be able to live close to where they can go out to a restaurant. They can walk down to a restaurant. They can go to a nightclub or a bar and then walk home afterward. Walk to the grocery store versus driving. So it's a huge deal to be close, like very proximate to jobs and retail when you're investing in apartments that are targeting a demographic that's like young professionals. And then wealth, if we're investing in the suburbs, we want to be closer to areas, neighborhoods that have really good schools, that have good demographics, not a lot of crime, because those are the most solid, kind of like long-term solid performers in the apartment and kind of the suburban apartment space. Now, I will so give you the master's class version of this now. You can invest in great locations, the returns aren't as high. If you can get ahead of that, if you can predict trends in where the momentum is going, that's how you make a lot of money in real estate. So if you can get ahead of the jobs coming into a neighborhood, if you can get ahead of the retailers, or maybe just on the front end when the retails and the restaurant is just starting to come into a neighborhood, or where wealthier families, middle class, upper middle class families are starting to move in. If you can get there before them, that's how you make really good returns in real estate. And there's this quote right here, skate to where the puck is gonna be. That's a Wayne Gretzky quote I'm sure you guys have heard. Don't skate to where I think somebody asked him, I don't know, how'd you get so good at hockey? Skate to where the puck is going, not to where it's been. All right, so I'll give you an example of getting in ahead of the growth of the momentum. So we've got, this is Denver. This is a shot of Denver. This is the Denver Rhino Arts District. Denver in the background, downtown Denver background, Arts District in the foreground. And some smart real estate investors noticed that there was starting to be a lot of momentum. You had some artists coming out and doing murals and some interesting stuff, setting up shop, then restaurants, and more momentum. Finally, apartments started getting built, but by the time the developers came out to start building apartments, this place was already starting to blow up as far as young people moving into the neighborhood. So just a couple of shots. This is what Arts District used to look like, really run down like in the 90s, 2010. It started to really turn around, and today it's a very, very happening location where everybody wants to be. So again, this was an example of getting in ahead of the growth and trying to identify like the next Rhino Arts District, trying to identify the next Sugar House, because Sugar House at one point had that same kind of revitalization. So I'm getting short on time, so I'll kind of skip through the rest of this. You can do the same thing on as far as market selection, trying to get into the market before the momentum really hits. And then just some of our projects that we've done where we've done this successfully. Got into Tampa in 2020, right as COVID was hitting. During COVID, rents grew like crazy. In the submarket we invested in, we bought 30 acres right near downtown, and rents grew 40%. From the time we closed on, from the time we got the land under contract to now, rents are 40% higher. This was probably the best investment we've ever made. So, and again, I'll skip this, but this is just talking about how we do things a little differently. We invest as the GP. It's better economics, boost your returns versus just coming in as an LP investor. And how that works is, last slide here. If you invest as an LP in a deal that made a 15% LP IRR, we make a 20%. So 1.9% multiple versus 2.3. If the returns are better, it's kind of an exponential effect. So 29 versus a 20 IRR. So it's unique, something unique to what we do. We invest with some of the top developers and sponsors across the country. And we'd be more than happy to answer any questions that anybody has, whether at us, what we do, or just real estate in general. But again, appreciate you guys having us out. Excited for the relationship to get going, and excited for you guys to have another awesome summer, crushing it doing summer sales. So thanks again, and have a good night.
Do you guys have any questions? Anybody? Yeah.
So I'm just curious, I know Texas Instruments is coming into Saratoga with an $11 billion project, and I was curious if they had their hands in anything or any apartment buildings that are going to be going up in that area.
Sorry, did you say Sarasota?
Saratoga,
Saratoga.
yeah, the Texas Instruments $11 billion project that's coming to Utah. I'm just curious if you guys have any insight on that.
I actually didn't know about that. Do you know anything about that? Eric?
Oh.
So now I'm guessing that's a chip factory. Is it? Or is
A what?
is it a chip factory?
I honestly don't know. I just know that they have a project coming in, so I was curious if you guys knew more about
Yeah,
that.
no, I don't know anything about that. I do know that Facebook built a data center out near the same area, and you know, it's just every product type in real estate is different, and you're doing it for different reasons. I'd say the effects of having a data center, the effects on the economy and the real estate market out there of having a data center are significantly different than having a chip manufacturing factory. With chips, you're going to bring a ton of jobs in, high-paying jobs, and it's going to have a huge positive impact on the surrounding community. If it's a data center, you're going to have like 5 people working there. Even if it was a $5 billion facility, it's just there's not a lot of bodies that need to be around to manage those. So, apologize I couldn't answer.
It's a semiconductor wafer fabrication plant.
Okay. So yeah, I buy real estate in Sarasota Springs.
A lot of good quality jobs there.
Yeah, for sure.
Okay.
My question was about investing, like, you were talking about, like, you know, the job, I forget the exact 3 words you used, but, you know, about location.
Yeah.
I'm thinking about, like, places like Salem, like, there's really nothing there. I'm thinking about, like, getting ahead of the curve, but I've seen a lot of new townhomes in Salem area. I guess people are kind of moving more far away kind of from the Provo area, the more expensive it gets. Do you guys have any, like, stuff that you think Salem might be, areas like Salem will have any potential in the future or stuff like that with new townhomes, maybe commercial places, stuff like that?
So refresh my memory. How far? Salem's south of Provo, right?
Yeah, it's like 20 minutes from Springville.
South
probably.
of Payson?
Yeah, yeah, or south of Payson,
South of
yeah.
Payson. So our rule of thumb for Mercatus is we have to be close to jobs. If there's growth in housing in an area, that is not a reason for us to get involved in an area. There's got to be jobs coming into an area. That's what's going to drive your rent growth, and rent growth is what's going to drive appreciation of your real estate assets. So I would say, and I don't want to kind of jump to conclusions and prejudge an investment, but I would say I'd be much more focused on areas that are closer to job centers. And during COVID, people were moving far away from the office. What's happening now is that's starting to kind of reverse, and people are getting closer in, because while some companies are allowing employees to not come into the office at all or to come in, 2 to 3 days a week, a lot of companies are requiring people at least part-time back in the office. So it's kind of the traditional rules to investing in real estate, I believe, still apply and probably will apply for a really long time.
Yeah, thank you.
In the back.
With cap rates being so compressed the last couple of years, specifically in multifamily industrial, have you found that with rates increasing the last 6 months, a year, it's affected those cap rates, specifically in those asset classes?
Yes, absolutely. So I'll take a step back. in Mercatus Partners specifically. So you mentioned that cap rates compressing through COVID. We made a decision at that time. We felt like properties were very overvalued with those lower cap rates, and it was extremely competitive. So we developed properties through that period of time. We could develop to a healthy development spread over buying in-place assets and not get into a competitive bid process and overpay for a property. We've now started to see that shift, and earlier this year, we made the decision that our focus now moving forward for the next 1 to 2 years is going to be in the acquisition space, buying existing properties, because cap rates have started to rise, values have started to drop, and we expect that to continue even further from what it is now. So we can come in and buy a property at a lower value than what it was sold for maybe 2 or 3 years ago, and own it and operate it for 3 to 5 years, and hopefully sell that property into an environment where cap rates are starting to come back down again, interest rates have come down, and values are going back up.
Thank you. You answered what was going to be my follow-up question.
All right, perfect. There we go. Anyone else?
So how about another round of applause for these two guys? So these two guys have been just amazing partners for myself and for Brett Belliston, our other partner, and just so grateful for them and the expertise they bring. I think you guys are kind of seeing a pattern, those who have made it to a few of the presentations now that I've been part of with other members of the team, is that you build smart people around you and you build a team around you, and that's a big way to become very successful in investing. So there's a QR code up here. You can snap a picture up there. That will get you to Austin. Austin, can you stand up? Any of you that would like to talk or have a free consult, we're happy to do that. I don't know where you are and what phase of your lives and what you're working on, whether you're married, single, you're just getting into summer sales, whatever it may be, but we're happy to help. And we're here to help. And we've worked hard to put together a opportunity for Moxie, because of our great relationship with Moxie and with you, and cheering for your success, to help you get involved with some of these things if you want. It's not like we're having a hard time filling the mandates we have, you guys, honestly, but we'd be happy to help you, educate you, teach you, and be your coaches as you progress throughout your careers. And that's why someone young like Austin, who's coming up through the ranks, is looking to have great partners to help them to be successful in their financial lives. So just know that that's available for you because of our relationship with Moxie, and we've done that on purpose to help you become more successful, because you guys are just doing this amazing thing of going out and earning the kind of money that you have the opportunity to earn. It's just amazing. I've said this before, Jason's heard me. Had this been available when I was in college, I would have been all over it, given where I was heading in my life and with my skill set. So just so happy for you guys that you have the opportunity to work for such a great company and really to go out and make a difference in people. And that's part of the conversations I've had with young people that are going out door to door that maybe are struggling. I said, you've got to have a paradigm shift. And I have no idea how you train this, Jason, but I know you do. And that is, you're making a difference in people's lives by debugging them, right? Honestly. And you can make a difference in people's lives. And so that's how the mindset you have to have, whether you're doing real estate or whatever your career path is going to be, is how are you going to add value to people and how are you going to make a difference in their lives? And once you get your head around that and get committed to it, then you have a great chance to be successful in no matter what you do. But you have to figure out how to add value and how to make a difference to other people. So with that, thank you very much. Once again, QR code's there. Take care, and Austin's happy